You sit down to figure out what life insurance is actually going to cost you. But instead of a straight answer, you get trapped in gated quote forms, marketing estimates, and endless phone trees. Before signing a financial contract that stretches 10, 20, or 30 years into the future, you need a reliable baseline. You have to know the actual starting point. Getting this initial math wrong carries a heavy penalty. Misjudging your premiums by just a few dollars a month compounds into thousands of dollars in overpayment over the lifespan of a policy. The problem is that life insurance companies do not use flat retail pricing. There is no standard sticker price. Instead, carriers run your profile through a strict, personalized mathematical matrix to evaluate risk. Because of this, searching for a standard average is a flawed strategy. Without understanding the specific hidden variables that underwriters actually use to grade you, those online estimates mean nothing. To see how this works in practice, we can look at the data for a standard $500,000 term life insurance policy. For a 30-year-old, a 10-year term is $13 to $20, and a 30-year reaches $45. For a 50-year-old, a 30-year term spikes to $180. Notice the spread, a massive gap from $13 to $180 inside this average matrix. This massive variance exists because carriers do not sell products based on aggregate charts. They sell policies based on your specific biological and behavioral data. The concept of an average cost is a mirage. The rate you actually pay is dictated entirely by a personalized scorecard of underwriting variables. We can break these underwriting variables down into strict filters that systematically push your baseline premium either up or down. First is age. Actuarial risk increases every single year you get older. Waiting to purchase a policy permanently shifts your risk curve, locking you into a mathematically higher monthly floor. Biological sex also influences pricing. Because women have statistically longer life expectancies, they typically see structurally lower monthly premiums compared to men. But remember, the most volatile and heavily weighted multiplier in the entire biological matrix is your medical history. This dynamic section of the scorecard shows what happens to the baseline price when a pre-existing medical condition is detected. An underwriter's system flags the condition, triggering an immediate compounding increase to the premium. To complicate matters, there is no universal standard. Different insurance carriers will look at the exact same medical condition and penalize it at vastly different severity levels. Your biological factors establish an inescapable baseline risk profile. If you have anything other than a perfect state of health, a standard automated quote is highly inaccurate. Beyond biology, underwriters look closely at the active behavioral choices you make, which can trigger entirely separate risk multipliers. Engaging in high-risk hobbies like scuba diving, flying private planes, or amateur racing triggers automatic red flags in the underwriting system. When you use a direct-to-consumer quoting algorithm, these specific lifestyle flags frequently cause the system to either reject the application entirely or automatically inflate the price to maximum levels. However, the single most punitive behavioral variable in the entire insurance matrix is tobacco use. This comparative chart illustrates the severe financial penalty applied to smokers. When a tobacco use variable is factored in, a standard baseline premium instantly doubles or triples in cost compared to a non-smoker. Despite these severe penalties, there are specialized industry workarounds. Smokers can still secure affordable coverage, but only if they know exactly which specific carriers are lenient toward tobacco use. These behavioral multipliers ensure that a one-size-fits-all quote will misprice the risk, leaving you with either an unnecessary rejection or a massive long-term overpayment. The final set of multipliers comes down to the structural choices you fully control, your coverage amount and your term length. This chart plots monthly premium cost against coverage length. Selecting a 30-year term reveals a steep upward cost curve to secure that longer timeline. But you lock in a stable trajectory, shielding you from the severe cost spike of reapplying at year 10. The cost of securing that level of long-term security is straightforward. You have to commit to significantly higher immediate monthly payments today. Selecting the optimal term length requires an ROI analysis that balances your immediate cash flow needs against 30 years of risk protection. The underwriting matrix is a highly complex system. Your age, health, behavior, and policy structure all interact simultaneously to generate one single number. Attempting a do-it-yourself approach to shopping for life insurance across this matrix is mathematically disadvantageous for almost every applicant profile. This flowchart shows what happens on the DIY path. When you blindly submit personal data to multiple direct-to-consumer sites, you often end up with mismatched risk profiles. The results terminate in either heavily overpriced premiums or outright application denials. This vulnerability is especially severe for older applicants, smokers, or those with complex medical histories. Shopping for quotes on your own almost guarantees you will be penalized. Relying on generic average charts or direct-to-consumer websites is a trap. Those algorithms are designed to protect the carrier's bottom line, not to optimize your monthly rate. To bypass the DIY trap and access wholesale market pricing, you need the specialized resources of an independent broker. This updated flowchart illustrates the operational advantage of a broker. Instead of a blind search, your specific data flows directly to the annuity expert. The broker analyzes your unique variables and routes you through dozens of options, finding the exact carrier algorithm that mathematically favors your profile to secure an optimized rate. By moving past the manual DIY search, you access a mathematically optimized rate that is guaranteed for the life of the policy. The best part is that accessing this expert brokerage network and having them run the market matrix for you costs absolutely nothing. Stop guessing your future based on flawed averages. Contact the annuity expert by phone or through the website today and let them secure your true personalized rate.